Successful Minds with Patricia Barnowski-Schneider, the show that takes you around the world to share interviews with some of the most successful and relevant people on the planet. Hear their stories and get the most important business lessons they have learned on their road to success and get exclusive advice on how to implement their success into your life and business. Successful Minds with Patricia Barnowski-Schneider is brought to you by the Strategic Advisor Board and your host, Patricia Barnowski-Schneider.
Hello, and welcome back to Successful Minds. I'm your host, Patty Baranowski-Schneider. Today, I'm joined by Steve Selengut, a private income coaching and investment portfolio review for The Income Coach. So welcome, Steve. Tell us a little bit about yourself.
Well, Patricia, it's great to be with you. I had been a private investment portfolio manager for more than 40 years or so. Wow. All individual portfolios, no models and stuff like that. I actually is hands-on doing orders for about 300 different portfolios, maybe 140 clients.
Wow.
So it was a busy, active trading environment, but it was different in focus than most of those types of things. I always focused on income.
Okay.
And I told my clients what my objectives were and that I was going to make sure they had more income than they needed to spend for their regular expenses. Nice. And I also was going to make them more in profits than they paid me in fees. So those are my two, you can't say guarantees in the business, but you can say these are my objectives. This is what I was trying to do. Some years you'd make enough in profits to pay 2 or 3 years fees all in 1 year. Sometimes in certain bad years, it might be a little less, but overall, that was what the objectives were. That's awesome. I did this for this most of my career. I was doing it primarily in common stocks.
Okay.
And then and for the fixed income side, I was doing things like Ginnie Mae's, which you don't even hear about anymore. Corporate bond trusts, probably about the same, and preferred stocks. And then some individual bonds like municipals.
Okay.
But then about 25 years ago, I discovered closed-end funds. And I don't have to tell you a lot about closed-end funds because I know you're pretty much of an expert in the area. I shouldn't even say pretty much. You are an expert in the area. So, so I discovered a whole new world of the income investing. Bonds, preferred stocks, corporate bonds, CEFs, as you know, make them liquid investments so that you can trade them just like stocks. And it just really blows your mind when you start trading portfolios of bonds, just as if you were one of those high-paid bond traders on Wall Street, except instead of getting all frustrated every time interest rates went in one direction or the other because it raised the prices, so it was tougher to sell them, or it lowered the prices, so it looked like you had less money. You just took advantage of those things instead, Yeah. So it was really an eye-opener. It made it so much easier to use that income focus. And then a few years after I got involved on the income side, I then decided, well, I own these things like, I don't know if you remember Petroleum and Resources before they changed their name. Mm-hmm. They every year, particularly, with the way things went in the oil industry, how the stock prices just go up and down, up and down. It was great. But every year they'd pay this huge, huge dividend, around almost like a Christmas present. And so I started buying that one in September and closing and selling it before the actual dividend so that I get the whole piece of the dividend, but I didn't have to hold on to the stock for another year for the next one. So I started trading it.
You learn the tricks of the trade.
Are there any, why there's not just one of these, there's got to be more. And I discovered the whole group of them. And I totally, with by the time we got done with this financial crisis in 2008, 2009, I was totally out of stocks and totally in. And I gradually got to that position, but by that time I was out. Yeah. And it's been easy for me to keep my income promises.
Yeah.
And now in retirement, it's easy for me to keep myself traveling around the world. So
Yeah, I have a friend of mine who works 6 months a year. The other 6 months he lives off his dividends. I mean, it's money to be made there if you know what you're doing, which is
yeah,
perfect for you.
right. Yeah, it's been, so that's been where I've been spending my time. And now, of course, I've been coaching other people on changing their portfolios, not just from market value focus, but to income focus, but also you can't believe the types of problems people don't even know they have, like diversification problems, like over investment in one single stock making up 50% of their portfolio. And I'm talking about seven-figure portfolios. It's scary. And I asked him, does your contact at Schwab or Fidelity or if they actually have a hands-on advisor, does your advisor ever caution you about this? And, as many times as not, the advisor is the one that's put them there, which is, so you get some these sad stories and you try to correct them. So it's been a good ride.
It's a shame because people rely on the advice. They don't know it themselves. So they'll, rely on their advisor. And I know somebody personally who's going through that. They have, lots of money invested and everything gets blown on. Oh, but in 2022, the stocks are bad. Right. And then it picked back up. And I get it, but it still doesn't show if you've had an investment for the past 10 years with that much money, how you're only up 10,000. I don't care how bad it was in 2022. Like anyway, it's a shame because I went through this way back in the day when I was 18. I had my kids' baptism money and all that stuff, and I put it aside and I didn't want any risks. So we did like low investment just so that they could grow a little bit by the time they were 18. And the stock market was tanking and I'm not their biggest client. I don't have billions of dollars. So they just didn't care. And it went to zero. And I'm like, wow. Oh my God, like, he's like, well, what do you want to know? The stock market was down. And I'm like, you could have taken it out and put it in cash. It used to be the client was who they were working for. It just seems nobody cares anymore. So it's unfortunate that people are relying on people that are not trustworthy. Not you, obviously, but it's typical.
You almost can say that, look, I understand why you can't focus as much on me as you want to, because I understand how you're getting paid on market value, AUM, right. Assets under management. Right. And your boss has given you these model portfolios and all these other tricks and doodads and gimmicks to give to your investors. And he's told you that these things are managed by professionals and that they're great. When in reality, they're kind of comical.
Yeah.
If you open up a person's portfolio and you see he's got one share of Berkshire Hathaway, because that's the percentage of the model.
Right.
I mean, that's ridiculous. That's ridiculous.
Yeah.
So caution to all your listeners. If you ever open up your portfolio, you've got one share of this and 3 shares of that, and then 126.32 shares of something else. You're in a model. The guy you're talking to is not making the investment choices for you.
Right.
He's merely putting you into a one-size-fits-all package.
That's a shame. Now, I guess, you talked a little bit about travel and whatnot. So tell us, what's the goal of income independence?
Income independence and travel have a lot to do with each other. It's really, that you're getting enough income to do what you want to do, regardless of which way the market is going. So if the market is going up, your income is good and you can add to it if you take profits, or you can just ride it and just keep. But if the market goes down, the income continues to come in. You don't have to worry about that. With closed-end funds and with most of the investments that they're actually invested in, the distributions, the dividends, the interest, that doesn't change. It's just the price that goes down. It's just like, a house in the housing market or anything, other kind of market.
Yeah.
You really don't have to worry about it and concern yourself about the market value. That's the goal. You want to be in that position. If you're off doing something and you hear that the market just tanked, you heard about, you're out on a golf course in 9/11.
Yeah.
what would you have been thinking, about your investments when you heard that the market went down, that they had to close the market because everybody was selling? What would you have done, And if you're in closed-end funds, you would say, well, you'd say, man, it's the most terrible thing I've ever heard about, but there are going to be investment opportunities tomorrow.
Yeah, I bet you need somebody like you who can guide them in the right way.
So that's the type of thing. That's income independence. That's financial independence. It's income independence. A lot of people think they're financially independent if they've got a 7-figure total portfolio, but that 7 figures, look at March of 2020, can become 6 figures very quickly.
Yeah.
And if you have a portfolio full of income producers like we do, then you don't have to worry about that. You can take advantage of it. So you've got independence, and you've also got the flexibility of whichever way it goes, you're either taking advantage of it by taking profits or taking advantage of it by gathering higher yields when prices go down.
Right. Nice. Now, you talked a little bit about this. So what fuels the yacht or pays the bills? Market value or realized income?
Okay. I think it's clear. It's the income. When you say, all right, I've got let's say a son who's a soccer fan and he wants to go to the World Cup, and he's got to accumulate some. That's a big expense, and most people don't have it. If you just have market value, you're going to have to sell something to get there. If you have an income portfolio, you can accumulate the $30,000 or $40,000 it's going to cost you to spend a week in Spain, or watching that going on. So so that's the difference. It's not market value. It's the income that you need to keep your lifestyle going.
Right, 100%.
Particularly if you travel.
Yeah. Now, what are the 4 great financial risk minimizers?
Well, when you're investing, before you take your first step, before you buy your first closed-end fund or stock or bond, whatever, there are really 4 things that you need to do to keep yourself risk minimized. Financial risk is the risk of the company or entity that has the bond, that you're buying that debt security, or you're buying the ownership of a company. Financial risk is of that company not paying the interest or going out of business and the stocks become valueless. That's financial risk. So that's what you want to reduce. The market value risk that they talk about, and that's all they ever talk about. Market's down. It's, oh my God, it's a bad day. It's a good day. It's always a good day. But, market risk is really not risk. That's the nature of the market. I mean, take a look at any chart, bond market, equity market for history. It's always gone cyclically up and down. So the 4 things to prevent the financial risk, the first one is quality. And no matter what you invest in, there's always a way to determine the quality of a security. If it's a stock, does it pay a dividend? Is the company profitable? How long has it been around? Does it raise its dividend frequently? What's the debt to equity ratio? If you really want to get into the technical aspects, price earnings ratio, PE. Everybody hears about that. So, so you can make up your own rules for all kinds of securities. For closed-end funds, I won't buy one unless it's been around for 5 years, so I can look at where it's been and what it's done, how it's been paying. It has to have at least 50 securities inside of it. A closed-end fund is like a mutual fund in that it contains perhaps hundreds of different companies in the equity side, and hundreds of different company bonds or corporate bonds and so forth in the fixed income side. So you can make up these quality rules. You can, and one of my quality rules is different from most people, and they'll probably raise an eyebrow. My requirement is that it has volatility. I want volatility because I see volatility as an opportunity to take profits, to buy it lower. So if it passes all my other tests, and it's also volatile, then it's the perfect thing for a portfolio that I'm managing.
Right.
So that's, I think that in the book, I wrote a book on this very subject, of course, retirement money secrets. I go through the 4 pillars of risk minimization, and I add on 2 other principles. One is that recognizing that the market and interest rates are a cyclical animal,
Right.
and the 6th one being the focusing on income instead of on market value. But the second risk minimizer, of course, and everybody knows this one, is diversification. I never want to have, for any of my clients, I never had as much as 5% of their portfolio capital in any one security,
Right.
or 15% in any one sector. You can also diversify by making sure you have global involvement, because no matter what anybody says, we are a global economy. Things like that. There are the different sectors. You got healthcare, you got energy, you got tech. People right now, I would say that 50% of the people who are listening and are in the stock market are overweighted in tech. I mean, they can be overweighted in tech just by not selling some of their successful holdings. They can be overweighted in tech. So, so those are the types of diversification is very, very important for safety. My 3rd pillar is income production.
Right.
I've never, ever, even when I started when I was 25, I never owned a security that didn't pay some form of income, dividend or interest.
Right.
And now when you see the difference between this in the stock market, you'll see that most tech stocks do not pay any dividends.
Right.
Microsoft pays less than 1%. Amazon, if any, less than 1%. Most of them, 0.
You could keep the money in the bank for that kind of cover.
Right. I mean, and these guys, they pay their employees pretty well. They pay the executives, more than you can imagine.
Yeah.
But you are an owner of the company. They're not showing you any respect at all with the dividends they're paying. Yeah. It's your money that got them started.
Yeah.
If that IPO didn't take, they wouldn't be in business today.
Right. No, I agree 100%. I mean, it is funny because some people, they don't like closed-end funds because they say it's not as risky, blah, blah, blah. And yeah, you're right. You can take a big risk and get a great reward. I've seen people lose their homes, lose their families. You want to have diversification. You want to just not have all your, ducks in a, but again, trial and error, that's how people learn.
But what I tell them in response to that as well is that, well, you own equity closed-end funds. You still own NVIDIA. You still have tons of Microsoft and Apple and Amazon. Just take a look at what's inside. Right. But you don't have all your eggs in one basket. Yeah. Like you just said, you have a wide diversity of these securities and a professional manager looking at them every day. So if NVIDIA doesn't meet its income projections, when high attention companies like that don't meet a target, they tank. They just tank because the speculators aren't interested in it. Right. So you don't want to have all of those and nothing else. Right. You want to have diversity, like we said before. And one of the key ways, when you do it with equity closed-end funds, you're owning those very same companies, but you're getting paid 8, 9, 10% in distributions, mostly monthly. Yeah. I don't mean 10% a month. I mean an annualized 10%. So it's a whole. It makes it. You can take on the same risky items of the stock market in a less risky environment, and that's the magic. I mean, that's why mutual funds were developed. That's why mutual funds are so popular in 401ks and other retirement plans, because they're safer. Yeah. Well, closed-end funds have been around about 30 years longer than mutual funds, and they've been doing this a long time. But the key element there is that they're not mutual funds.
Right.
A lot of people call them closed-end mutual funds. They're not mutual funds. They're trusts. They're trusts like you set up for your kids, you know.
Yeah.
And they have to pay out 95% of their earnings, not to their executives, to their shareholders. So it's a whole different ballgame. Okay.
But it's
The
good.
final, the final risk minimizer is one that you'll never hear from anyone else. At least not, and that's profit taking.
Yeah.
Okay. If you took your profits, think of any of the cycles or any of the corrections in our lifetime from 87 to 2000 to 2008 to 2020. If you had taken your profits up on the way while the market was going up and everybody was all jubilant and all this stuff, you wouldn't have lost nearly as much. And you probably would have known enough not to panic and sell anything either. If you did all the other rules. So, so if you don't take your profits, the higher the market goes, the riskier the market is. And if you don't take profits, you're accepting more risk. So those are the four legs of them. That's the four legs of your stool.
Right.
And if you don't do one of them, you're going to fall.
Yeah. I agree 100%. And again, most people aren't educated enough in this sort of thing. So they rely on the guidance of whoever's managing their portfolio. But like I said, I've seen it repeatedly. That doesn't necessarily mean that, unless you're some billion-dollar client, they don't care, which is unfortunate, but they need somebody who understands. And they never look at closed-end funds. I mean, they like don't. The low end, and no one ever talks about it. It's bizarre.
And they're because they're not exciting. I mean, they're not designed. If you're running a business and you have to give away, if you have to give back to your shareholders 95% of your income, I mean, you wouldn't be able to go out and put up more stores or, own more properties or do anything, right? All you have to be is you buy a few hundred more shares of some of your securities with that 5%, but you wouldn't be able to grow the company. So you have to realize with closed-end funds, they have a very narrow trading range. And they're more influenced by the direction of interest rates than they are by the direction of the stock market.
Yeah. And it is a little odd that even people who kind of do invest in it, sometimes you can always tell, like, because I'll have the 800 numbers always ring on my desk, and I'll get people like, they just assume that it's going to be like buying stock of Google, but it was $10 today. That was 2 years ago. Why isn't it $50? Closed-end funds don't really work that way. Again, like you said, you have the security, you have the consistency, you have the dividends. It's meant to be a secure investment to help you live off of for the rest of your life, not to be rich overnight. Because if that's the case, then take your chances with a stock and hope for the best, because when things are good, they're great, but they go bad very quick and then you lose it all. So which would you prefer?
Yeah, exactly.
They need guidance.
They do. And like you said, not even too many financial advisors are educated in the closed-end fund area. Yeah. I mean, I go on LinkedIn, and there are groups of advisory people, professionals, in various financial fields. And I go in and I send them a message. I tell them, I want to partner up with you to bring your clients more income. I'll show you mine, I'll show you how to do it. I'll coach you, and you can get all the smiles when they make more money than they are now. And I almost next to never get even a response.
Yeah, they probably all think you're going to steal their clients. It's like,
well, I mean, one of them called me a snake oil salesman.
Oh my God!
It's impossible. You can't do that. Of course you can. You just have to.
They don't believe it. Yeah,
you have to look around. It's so. Anyway, so now that I'm pretty much retired and I've got this coaching business, my goal is to bring my snake oil to as many private investors as I can, to see if I can get more people see if I can run into some of these people when I take that Amsterdam to Budapest
Right.
next April. When I do that 2-weeker on Viking, I want to run into somebody that I've been a coach for on that ship. That
Nice.
they don't know I've made an impact. There'll be other people out there.
Right. No, it's amazing. And I think some people, like, unfortunately, it takes some getting seriously burnt to realize, okay, there's got to be a better way. There's been a way all along. You just always were, trying to reach the high end ASAP. It's a process,
Right.
because that doesn't always work. What is it, like 1%? But yeah.
Well, one of the things that keep people, the average person, around the average person from finding out about things like closed-end funds are the rules associated with 401ks.
Yeah.
They're the fees that the mutual fund managers. That's why Vanguard came up with these 0.5% funds. I mean, if they have $16 billion in one fund, if they're only getting that, it's still a lot of money.
Yeah.
But they also have the other funds that normal people get that are 1.5 and 2.5, whatever.
Mhm.
But closed-end funds are actively managed funds, and they don't charge the investor,
Yeah.
but the fees are taken from the income of the fund before the investor. So we're getting a net 8%, a net 9, a net 7, whatever. It's after expenses.
Mhm.
But the expenses are too high for them to qualify to be included in 401ks.
Right. Unfortunate.
And I've heard people whose advisors have told them, no, you don't want to do that because their fees are very high. Because they don't even know that those fees aren't really charged. I managed all that money for all those people, and not one of them ever paid a fee to a closed-end fund.
Yeah, it's like the fine print nobody reads.
There you go. There you go.
So now tell us, what's market cycle investment management?
That's like we discussed a moment ago, where you have to expect these ups and down movements in all securities, and it could be by interest rates, could be from economic conditions. We've seen it from health scares. Mm-hmm. You can see it from wars. You can see it from what else? Various other things that'll affect the economy. But the market will react to it. And if you look at the chart of any sector, any individual sector, healthcare, retail, whatever, you'll see a wave. Normally they'll have an upward trend, but there'll always be an up and down cycle. And sometimes they're longer than others. The interest rate cycle typically, up until this last run up from 0 to 5%, has been a very long cycle. That was the fastest uprise ever in interest rates since the 80s, when it went up to 12 or 14%. But right now, most people don't realize that right now we're at the low level of normal historical interest rates. Right. It's 5%, but that's low normal. Anyway, that's the type of thing that market cycle is. The stock market will have this up and down, upward biased trend. Mm-hmm. And you can tell, you don't know what's going to happen next. You don't even know what's going to happen tomorrow. But you can tell whether you're near the top or near the bottom just from where it is. If it's way up here, like right now, yeah, it's, some things are at their all-time ever high. So yeah, you're at the upward end of a cycle. So you don't want to pour money into the stock market, but you can put in, especially if you're using closed-end funds like I do, you could take half a normal position. Yeah. Because it's going to go back down, you buy more of it later. You reduce it. If it's still paying you 9%, the price isn't all that bad.
Right, for sure.
So you just buy less of it, and on the other hand, in 2022, when the market was down, you could go in and say, okay, all of these stocks are at the lower end of their normal trends, and it's safer to buy them then. So the higher the market is, the more risk there is in stocks.
Right.
So if you're still, let's say you got a huge portfolio like yours, okay, you buy the same closed-end funds in the equity side, but you just buy less of them because the chances are more likely for them to go down than to go up further.
Right.
So that's market cycle management, knowing where you are in this cycle and anticipating what, and of course, taking your profits when they're up, that's part of market cycle direction.
Right.
Management, and buying when they're low is lower,
Right.
So that's market cycle investment management.
Nice. Now we talked about interest rates. So why are higher interest rates and lower interest rates good news for income investors?
They're both good news.
Yeah.
Most people are saying how bad it is that the more interest rates are so high. Well, yeah, if you're a young person looking for your first home, yeah, you're going to suffer. Your mortgage rate's going to be higher. That's bad. But on the other hand, if you're the same young person and you just got your year-end bonus, the six-figure bonus that you love so much, you can now invest it even in the savings account at 5%. You can buy closed-end funds that are yielding 10, 12, and 13. So that's not bad news for you, is it? So that's the thing.
How you look at it, yeah.
So when what your financial condition is, how you've prepared for lower or higher interest rates are important. But higher interest rates in the long run are good, and they don't have to go up to 12%, but 5% in the long term for income investors is so much better than 0%. Because you're investing in funds of bonds that have like a 30-year lifetime, but there's so many out there that you can buy them and set up a ladder. But think about the bonds that were in these portfolios 20 years ago. They were maturing over the last 12 years. And when those 7, 8, 9% bonds were maturing in 2010 through 2022, they were you'd get a 7% bond maturing, and the manager could only reinvest it at 4%.
Right.
Or you'd have an 8% bond maturing, and you'd get 1.5 whatever. So for the last 10 years, our funds have been filling up with lower yielding securities. If you look at the variable rate closed-end funds, how they've raised their distributions like 5-6 times in the last 18 months because rates have gone up, and they've been able to do that. So that's the thing. If you're an income investor, 5% interest rates should be just fine for you.
Right.
Yes, if interest rates go down, which I think there's a good possibility before the end of the year, we'll see some of that. We're going to make a lot of money because our closed-end funds are going to go up in price with the reduction. So we're going to make a lot of short-term gains, put it back to work, but at lower rates long term. And we're going to have that. And if you go along with zero, if you could imagine an environment where you went along with 0 to 2% rates for 30 years and you got the entire bond ladder invested at low rates, it would be very difficult, other than the fact that our securities would have grown in value a lot, for us to maintain ourselves on a 2% or a 3% stream. Look at what happened to all these retired people. The average guy who has all his money in the bank, the average grandparents, all their money was in savings accounts and CDs. Mm-hmm. And we went to zero interest and the banks were giving them nothing. Where did they go? Their advisors didn't tell them to buy CEFs yielding 7% at that time. Mm-hmm. They put them in the stock market. So here you have people, the exactly wrong people to be in the stock market, forced into the stock market by low interest rates. It isn't always a good thing.
Yeah, no, it's unfortunate.
For everybody. Yeah. For everybody. At the same time, our government allows credit card companies to charge 24% on interest.
Insane.
So, where should their emphasis be?
Yeah, that's a shame. Now tell us, how's managing a portfolio like running a department store or shopping center?
That's good. I love this one. When you're all the rules, particularly the diversification rules and stuff like that, where you want to get something in all the different industries and so forth, it becomes, and particularly if you use closed-end funds, because you really have closed-end funds that pretty much cover everything. You can find one for every sector, every type of security. So what I do, and I try to own I have these universes that I vetted for all those rules we talked about before.
Right.
And I want to own all of them. Because then what I've got like a store. I've got something for everybody. And if a shopper comes in and he wants oil companies, I've got them on my shelf, right? In the form the prices go up to I'm going to set a target. My target on CEFs is 5%. If somebody comes up and wants to pay my markup, I sell it. Bam. I don't argue. I don't care if the price is going up tomorrow, because I've got another couple hundred closed-end funds I can buy tomorrow and have it in that sector. And I've got 15 different things in the energy sector and 15 in the healthcare, So wherever anything's happening, I'm just like Walmart. Like I got it on my shelves. Just let me find it. Here it is. There you go. Pay your money. You got it. And that's
awesome.
how I operate the fund. I don't fall in love with any products.
Yeah.
I don't. Yeah, I know, of course, which ones I've done the best with trading over the years. And if I see that I don't have any on my shelf, I go out and get it, put it back on there. But pretty much of the 240 odd closed-end funds that I have in my universes, I've sold over 200 of them at least once for profit already this year.
That's awesome. Wow. And we're only in May.
Now they're not huge profits.
Still, it's a
I mean,
profit.
yeah, exactly. I mean, it's a nice chunk of change. It's for right now, it's almost 3 months income. If you just held them, it would have been 3 months income. So I have 3 months income on top of the regular income.
Nice.
Just from taking small profits. And that's how I run my department store. I actually think of it now more of as a shopping center. I've got a bunch of department stores there. So.
Right. So tell us now, why is targeted profit taking so important in all portfolios?
Well, I think one of the things it helps with, it keeps you out of that trouble of falling in love. You'll have people that have, I get in my coaching business, I'll get people who have Microsoft from way back, and they, the profit portion in their portfolios is almost like 60 or 70% of the market value is profit. But they're generating zero income from it. So my idea, think about a Microsoft, and let's say if you go look at the chart from Microsoft from inception, and you'll see that same volatility that you do with pretty much most. I mean, the upward track is steeper, but you could have bought and sold it and bought and sold it and bought and sold it many times on the way, and made more than that 60% on it if you did it. And so that, that's why it's so important. It's also so important because are you the type of person that's going to not panic when you have a crash? I mean, how many people do you think sold their Microsoft or their Amazon or whatever the popular one that was in March of 2020?
Most of them.
A lot of people sold it probably at much less than they could have made because they panicked with COVID or with the crash 87. It was really bad. I mean, I had people who, I really thought were pretty savvy people of what was going on in the world, not just in the stock market. But there were a couple of people who wanted to sell out their whole portfolios then because this was definitely the financial end. They were sure. 18 months later, we were at an all-time high again, So.
Yeah, so you need somebody who has the experience and,
So if you set a target, and I know you can do this because a lot of the people in my Facebook group, talk about how they set their target at 5% with Schwab or with Fidelity, and it just goes off, and they know about it. And then the next day they reinvest what they have, they could put it right back in the same stock, same closed-end fund again, if they chose to. I don't do that. I usually wait. I keep track of which ones I've sold each day.
Right.
And then when I have available cash, I go back to the one I sold the furthest in the past. I don't look to see if the price was anywhere. I don't care.
Right.
But so then I started that last one. So right now, yesterday I bought things that I had sold previously between May 15th and now.
Okay.
I still have May 20, 21, 22, 23, 24, and 28 that I will buy in, in the next few days if I keep.
Wow.
And I sold about 4 different positions today.
Right. Wow. But that's good because at least you're monitoring, you're keeping track of this, and you have the consistency. It's not just winging it
Right.
and hoping for the best,
Right. And you don't have to be quite as hands-on as I do it. Like some of these people, like I said, they just let the computer sell it for them at 5%. You know what? I haven't asked them, and I'm the next guy I meet with right at the early part of June. I'm going to say, what kind of order do you put in when you have that 5%? Is it a stop order? Because if you put in a stop order, I think it goes to the next it becomes a market order to get sold.
Right.
And it could go down. I'm doubtful that it would go down and knock off, 2 or 3% in that instant. But these things, closed-end funds, one of the things that you have to be aware of is that there's not as much of them as there are stocks, so they're less liquid, and consequently the spreads are wider. So a stop order for a profit, if it's too narrow, it may wind up being a loss. So you don't want to do that at 1%. At a 1%, at a 5% profit, you're probably going to come out all right. You might even get more.
Yeah.
You might even get more if the energy is there.
Yeah. Now, what's the average yield right now in your closed-end fund selection universe?
The average, did these on right around May 13th. The equities, these are ones that own at least 65% of them is invested in the stock market. Okay. And there are only, 91 of these. The average price was $13.80. The average yield was $8.95.
Wow.
And
get that from the bank.
That's in the uptrend. Yeah. Wow. And the income side. Where there's about 103 of them. Average price was $10.84. And remember, the interest rates are still suffering from that 5-point rise. Mm-hmm. The average yield is $10.64.
Wow.
The average yield for tax-free closed-end funds right now is, I have about 45 of them in my universe, is 5.6%. Now, if you're making a lot of money and you have a big personal account you're really one of these guys that really hates taxes so much, 5.5% tax-free is not a bad thing.
Not at all.
And the thing about the tax-free munis, they're more volatile, they're more susceptible to changes because they're really, one-show pony. That's all they have inside. So when interest rates started to go up, a lot of them cut their dividends, but they've already raised their dividends to be above where they were when they cut them. But when interest rates go down, like they did in 2008, the closed-end municipal bonds, closed-end municipal bond funds went up faster than the S&P 500.
Again, these are things people don't know.
And you can't have as much fun than taking a profit on a tax-free investment.
Oh, for sure.
The profit is not tax-free, but you've done it on a tax-free investment. Right. That feels so good.
That's awesome. Again, things people don't tell you about.
Right.
Yeah. So now how should retired income-focused investors gauge portfolio performance?
Okay, that's where it becomes a mindset thing. Because as you and I were discussing before the interview, Wall Street is focused on market value.
Right.
Every word out of their mouth is about the market value and the value of your portfolio, the value of the securities, what the market price is now. And every word out of my mouth is saying how is focused on how much income I'm getting and how I can grow that income every quarter, every year without, without ever even worrying about market value. So coming around, changing your mindset, not getting upset when the market goes down like 600 points in the Dow. What was that last week?
Yeah.
So what? It didn't change one dividend on any stock in the Dow anyway.
Right.
But it certainly didn't affect anything except the price and created opportunities to buy them lower. And if you have income at 7, 8, 9% rolling into your portfolio, you always have some income available to take advantage of lower
Right.
prices. Yeah. So that's
amazing.
it's really a mindset thing. I love it when a coaching client starts when he calls me up and he starts talking about how he's managed to grow his working capital and doesn't mention the market value of his portfolio in an entire conversation. That's when a guy has got the income focused mindset.
Right.
Yeah,
That's awesome. Now I'm going to include your book and the link to where your book is, but anything else you want to talk about that we didn't cover already?
Well, we've covered the key highlights of the book, but it's got a lot more in it. It's got charts that show the difference between a portfolio of closed-end funds that are paying, 6, 7, 8%, even that low, versus BND, the bond, is it the Vanguard bond multi-index and the SPY?
Right.
The bond pays a little more income than SPY does, but neither of them pay the 4%. So, the 4% that you're supposed to take out of they expect you to take out of your portfolio in retirement.
Yeah.
So the difference between a group of securities that are paying 8% versus ones that are paying less than the 4% requirement, how the working capital, even the market value grows more than the SPY did over a 15-year period. So there's things that show you, and they show you the consistency of the dividends over the years and so forth. It's I think it's pretty well put together to get a person to that point where they say, even if I just do part of my portfolio this way,
Right.
I'm going to be able to make more than that 4% retirement bogey.
Yeah.
So I'll take some of my profits here and there. I'll keep enough Microsoft to keep my eye on the ball, but I'll take some of the profits. I'll get 10% on my money, and in the long run, I'll be better off. So
Yeah. Nice.
So the book can get you there. It's retirement money. Oh, there's a big announcement with that too. It's been on Amazon. It's sold almost. It should reach 2,400 today.
Wow.
For an investment book, it's pretty good.
That's awesome.
And the audio book will be out by the end of the month.
Awesome.
So that should be nice too.
Yeah. That's always easy for me. I listen when I'm driving, so perfect.
I know, and people have told me that the market for audiobooks is almost equal to the the hardcovers and the ebooks combined.
Wow, good stuff.
So, yeah.
Now, how could people get a hold of you and learn more about you? I'll include your contact info anyway, but what's the best way you want?
I do have a website for my coaching business, which is called theincomecoach.net.
Okay.
And that has all my contact information, emails, phone numbers, Facebook groups, and so on, that they can get in touch with me.
Nice. Well, thank you again for being on the show. Again, that was Steve Selengut. So thanks again for listening to Successful Minds with Patty B. And never miss an episode by subscribing to the channel. So thank you so much again.
Thank you for listening to Successful Minds with your host, Patricia Barnowski-Schneider. Please leave your feedback and visit strategicadvisorboard.com to get the latest and greatest business advisement on the planet. Follow us on social media for updates, and we'll see you on the next episode.